Thanks for joining us for our IAN 100 webinar. Just some instructions for the attendees. This webinar is being recorded and will be available later today on our YouTube channel and on the IAA website, as well as the slide presentation. If you do have any questions during the webinar, you can use the Q&A feature, and later on we'll take those questions at the end of the webinar. If you do have any questions and you would like to ask them verbally, you can raise your hand as well and we'll unmute your line. Go ahead, Derek.
Okay, thank you very much, Christian. And perhaps you could move to the first slide. Well, welcome everybody to this IAN 100. My name is Derek Wright. I am chair of the Insurance Accounting Committee of the IAA and was one of the co-chairs, along with Dave Finnis, of the task force or education and practice subcommittee, as it was then called, that brought together this IAN 100. As you'll see, we're going to, after a brief introduction, Brendan is going to talk about the IAN 100 in a bit more detail, and then Dave will be talking about our next steps. And then there will be time for questions and discussion. So if you could move forward, please, Christian. So a quick introduction to the three speakers this morning. Brendan is a co-vice chair of the IAA and is based in Australia. And he was responsible for leading on 3 of the chapters in this document. He had by far the toughest job of the lot. So thank you, Brendan, for that. Dave, as I mentioned, was co-lead with me on the document. Dave is a GI actuary and has many years experience, as you can see from there. And so thank you, Dave, for all you've done. Next slide, please, Christian. Okay, so just where does the Insurance Accounting Committee fit into the IAA structure? And this is the new structure. And I think more or less since the structure came about, we've been in lockdown. So it's, I'm sure it's working in practice, but there's not been any meetings of IAA delegates to actually just see this whole thing working as it now is. But you'll see that the IAA has an impact function, an assure function, and an advance function. And the Insurance Accounting Committee is part of the impact function, along with insurance regulation and a pensions accounting. Normally, we would have been meeting a couple of times a year in person, but for the last 18 months or so, we've had virtual meetings only. If we could move on, please. So what is an IAN? Well, as it says here, it's an education document on an actuarial subject that has been adopted by the IAA to advance the understanding of the subject by readers. It is not an ISAP. An ISAP is our model standards of actuarial practice, and they're not binding on any actuary, but ISAPs are principles based and are not prescriptive. The purpose of an ISAP is to increase intended users' confidence that actuarial services in connection with IFRS 17 are carried out professionally and with due care. Results are relevant to the needs and are presented clearly and understandably and are complete, and assumptions and methodology used are disclosed appropriately. So an ISAP really it is there as a model standard. It's up to each member association whether or not they adopt that and or how they amend it, and so they can apply it locally. An IAN is an education note to assist actuaries in complying with the ISAP, and it's also must be remembered it's non-binding guidance on an actuarial topic. It's there as education. It gives some examples, but it's not saying this is the only way you can do something. This IAN took a long time to develop. primarily because the IFRS 17 took a long time to develop. We didn't take quite as many years as the IASB. Sometimes it might have felt like it, but we always had to wait for the for where the standard was going to be able to reflect that in our document. There's also various internal mechanisms within the IAA before an IAN can be developed and published. So, you know, sometimes people might have been saying, well, why haven't we got it already? Where has it got to? But, you know, we were working on it for a long time, and it was a great team effort. We probably had over 60 actuaries from around the world contributing to the IAM. For each of the chapters, there was a chapter lead, and I'd just like to mention those chapter leads in no particular order. There was Henry Siegel, Ernst Visser, Kurt Lambrecht, Simon Curtis, Tara Wolf, Bob Nicholas, Gareth Kennedy, Grant Robertson, as well as Brendan, Dave, and myself. So thank you for all of those. And now Brendan's going to talk to us about what is actually in this IAM. Thanks, Brendan.
Yeah, thanks, Derek. Thanks for the introduction. So my name is Brendan Council. I'm based in Sydney in Australia, and I am going to talk to you specifically about the IAN 100 on IFRS 17. And what I'm going to do is I'm going to take you through some of the key, well, all of the chapters, and just summarise briefly what's in there and what is likely to be useful for our actuaries practicing in this area. So I'll get to the structure of the document in a moment, but as you can see, there's a link here to where you can find the IAN on the IAA's website. So I encourage you to have a look at that. As Derek's already mentioned, the document provides non-binding guidance and some practical examples to actuaries in interpreting and implementing ISAP 4, and importantly, IFRS 17, the accounting standard for insurance contracts, which comes into effect from 1 January 2023. The IAN is drafted in 5 sections, and we'll go through each of the 5 sections in a moment. But just to quickly cover the topics of each section. So the first section's I guess the core section on the general model approach. The second section, section B, on variations to the general model. And that includes some of the simplifications, as well as some might argue complications like variable fee approach and reinsurance. The third section covers uses of fair value for things like transition and business combinations. Fourth section on some miscellaneous other topics, and the final section on presentation and disclosure. Each section is split into chapters set out in a Q&A format. So there are 17 chapters in total, 252 pages of engaging bedtime reading for IFRS 17 enthusiasts. However, we understand that not everyone may wish to read it from cover to cover, but rather use it as a reference document. So in this part of the presentation, I'll speak to you about each section of the IAN and hopefully give some useful steer to what's in each section, so you can refer to that. If we could go to the next slide, please. So I've got each section set out on the next few slides, and I'm just going to briefly speak to each one. I'll cover what's in each chapter very briefly and how it might be of use to actuaries. If there are questions as you go through, as Christian said up front, put them in the Q&A box and we can provide any clarifications on any more details at the end. So firstly, Section A of the IAN. This is the including the introduction. So the introductory section just sets out some basic information on the IAN, on IFRS 17, and provides a summary of the contents of each chapter. So you can also refer to that just to see what's in there. It provides some introduction to International Financial Reporting Standards, IFRSs, and the context in which IFRS 17 has been developed by the ISB. It briefly covers principles of measurement and disclosure under IFRS 17, covered in more detail in later chapters. So then just working through Section A on the chapters there. So there's 6 chapters in total. The first chapter on classifications. So of course, under IFRS 17, this new standard covers insurance contracts. So this chapter covers the definition of what classifies as an insurance contract, significant insurance risk, provides a few examples of contracts. So hopefully the IAN is practical and provides useful examples throughout. Chapter 1 also covers a few other concepts and key principles, such as the contract boundary concept, separation of insurance components, and principles of aggregation. So again, for those familiar with IFRS 17, those should all be pretty familiar concepts, but it does set out some useful information for actuaries just looking to get a basic overview of some of the principles of the standard, and then understand what factors might affect classification and aggregation and boundary assessments for particular types of contracts. So then we get into chapter 2, which is the general measurement approach. So this is the basic building block model of the standard. So this chapter, the first part of this chapter, chapter 2 covers the estimates of future cash flows, which is the first of the basic building blocks of the general measurement approach. It gives, again, information on overall principles for estimating future cash flows, which types of cash flows should be included, which may not be included in the liability measurement, as well as some good additional considerations around cash flow assessment. I guess this one is useful, chapter 2 is useful for providing guidance on how to assess the future cash flows, including considerations for modelling and projection of these estimates. Then chapter 3, the second building block on discount rates. This discusses practices relating to interest rates, yield curves, discounting, replicating portfolios, etc., for insurance contracts. It covers general principles for discounting as per the requirements of the standard, and covers some of the techniques in a bit more detail. It specifically covers the 2 main approaches in the standard for setting discount rates. So these are called the top-down approach and the bottom-up approach, as well as a number of other, I think, useful topics for setting discount rates and yield curves. So topics such as illiquidity and illiquidity premiums, ultimate forward rates, and replicating portfolios. So I think this chapter is quite good, quite comprehensive, so it provides a good comprehensive summary of discount rate considerations. Then the final building, not the final building block, but another building block is covered in chapter 4, the risk adjustment for non-financial risks. The risk adjustment is a new concept under IFRS 17 for many jurisdictions around the world. Its purpose is to explicitly allow for uncertainty in the estimates of timing and the amount of future cash flows for effectively the non-financial risks or the insurance risks borne by the entity. So that's quite a, as I said, a new topic for many actuaries, and we hope that this chapter provides some good guidance to sort of setting the practice as practice develops in setting risk adjustment. There are a number of acceptable approaches to setting the risk adjustment, and those that have followed the development of IFRS 17 will be aware of them. The ISB did prescribe a number of acceptable approaches for a while, and then in a further version of the standard then removed that prescription. So it is an area that is quite open to judgment and different methodologies. So this chapter on risk adjustment, chapter 4, should provide a good summary of the key issues and considerations for actuaries setting risk adjustments for their particular portfolios of business. Chapter 5 is on level of aggregation. The level of aggregation is potentially one of the most significant topics, given the potential for it to impact financial outcomes for entities, as well as it having the potential to have quite significant practical and operational implications. So the level of aggregation is effectively the level at which the group or portfolio of insurance contracts is aggregated for the purpose of measurement and profitability reporting. And this chapter, chapter 5, sets out basic principles of portfolio aggregation and profitability grouping before covering some more specific questions relating to the level of aggregation. So questions around topics such as the assessment of onerous contracts, the impact of regulatory constraints on the level of aggregation, and transition requirements, among others. So I think chapter 5 is useful for actuaries wishing to understand which factors may and may not impact contract aggregation, both from a financial and an operational perspective. And then finally, for the first section of the IAN, chapter 6, the CS contractual service margin and the loss component. The contractual service margin, or CSM, as it's sometimes referred to, is effectively the driver of profit for a group of insurance contracts under IFRS 17. So quite an important concept. And we've also included in this chapter the loss component, which is where a group of insurance contracts is unprofitable, and losses are recognised for that group, and how these should be or could be treated under the standard. So this chapter is quite a lengthy one. It covers the setting of the CSM and some of the mechanics around it, both from an initial recognition and subsequent measurement perspective for insurance contracts. It covers adjustments to the CSM over time, and also the importance of coverage units, which is effectively the approach that IFRS 17 uses to release profits in accordance with the services provided under the contracts. This chapter includes a separate section covering the CSM for reinsurance and some of the key differences to treatment compared to for reinsurance contracts compared to the underlying contracts, direct contracts. So really good chapter, this one, for actuaries wishing to understand the complexities associated with the CSM and the loss component, and I think provides a good practical summary to some of the key issues. So I might move to the next slide, please, Christian. So that, I guess, that summarised the general measurement approach, which is the core of the standard. There are a number of variations to the general measurement approach, and these are covered in section B of the IAN. So firstly, we have Chapter 7, which covers the simplified approach for short duration contracts, referred to as the premium allocation approach. Now, the premium allocation approach, for those familiar with the standard, applies for to contracts with a contract boundary of 1 year or less, or where the liability for remaining coverage would not differ significantly from the general measurement approach. So the premium allocation approach is very much a simplification, a simplified method, and it doesn't perhaps include all the complexities of the general measurement approach, including some of those that I just touched on the contractual service margin, well, mainly the contractual service margin, and also to a lesser extent the loss component, although there would be the concept of a loss component under the PAA or premium allocation approach. So this chapter covers a number of questions relating to what we refer to as PAA eligibility. And what do we mean by that? That is where you might have a contract with a contract boundary of more than 1 year, and there are some contracts in non-life insurance in particular where the boundary might be 2, 3, 4 years, but where the liability for remaining coverage would be expected to not vary significantly over time from that which would be measured under a general measurement approach. So premium PAA eligibility is an important practical consideration, particularly for many non-life insurers wishing to use the PAA, where the contract boundary is more than 1 year for their contracts. And this part of this chapter sets out a number of practical considerations and questions and scenarios where PAA eligibility may apply or may not apply. So again, it's general information, and obviously practitioners should look at their own contracts and circumstances, but we hope it does give some practical scenarios around PAA eligibility, this chapter. The chapter then goes on to cover similar topics to the GMA chapters, so initial recognition, subsequent measurement, etc. Chapter 8 is the second of the 3 variations. So this is contracts with direct participation features. It covers all things related to the variable fee approach, or VFA, which is the modification to the GMA for contracts with direct participation features or investment contracts with discretionary participation features. So Chapter 8, again, pretty comprehensive, will be useful for actuaries managing participating life insurance business in particular, with profits business, and other types of discretionary mutual business, some unit-linked business that may be eligible for the variable fee approach. And finally, for this section, Chapter 9 on reinsurance. So Probably the thing to just mention here is because IFRS 17 is a contracts-based standard, it measures contracts. One of the quirks of IFRS 17 that many actuaries may not be used to under current GAAP approaches is that reinsurance effectively gets its own measurement. So it's measured separately under the standard to the underlying direct contracts, which may be something that we're not used to in our current GAAP in our local jurisdictions. Throughout the IAN, we've covered reinsurance issues in the relevant chapters where appropriate, but reinsurance is such a large topic by itself, and because of this change to approach compared to current accounting approaches, we felt that it warranted a chapter on its own. And there are some differences, as I alluded to earlier, in the measurement of reinsurance contracts. So the chapter covers measurement methods for reinsurance contracts, both reinsurance contracts held, for example, by a direct insurer that purchases reinsurance, and reinsurance contracts issued, so for example, by a reinsurer. It covers many of the complexities and nuances that those familiar with the standard will be aware of probably already, and some of the tricky bits relating to reinsurance specifically under IFRS 17. So I guess any actuaries that are advising companies with significant reinsurance arrangements in place, including those that are advising reinsurers, should have a look at this chapter, and hopefully it provides some useful information. If I can go to the next slide, please.
I think, Brendan, we're just changing over the pack.
Okay, sorry.
We had we had a near final pack and the final pack, and I think Christian is just cutting the later one up. I think
no problem. Yeah, that's okay. That's right. I'll keep going. I think the next one was my final slide, which covered the other sections. So I'll just keep talking, and Christian, yeah, when you're ready, put it up. Okay, so so then we've got three other sections in the IAN. Each of them cover a number of chapters 10 through 17. So the first is section C, which covers uses of fair value. Why is fair value important? Fair value approaches are used under IFRS 17 for the purpose of transition in some circumstances. So transition from the current GAAP to the new IFRS 17 standard, and also for determining the opening measurement for a portfolio that has been acquired in a business combination or portfolio transfer. So the section C has 3 chapters. So chapter 10 covers fair value approaches. There is a separate IFRS standard on fair value, and it covers fair value in, I guess, generic terms. So that's IFRS 13. IFRS 13, as I said, it's generic, but what this chapter 10, aims to do is just to provide some practical approaches on how IFRS 13 can be applied to insurance contracts specifically when determining the fair values for the purpose of transition and or business combinations. So that's chapter 10. Then chapter 11 and 12 then go into the more specific in IFRS 17 requirements. So Chapter 11 covers business combinations and portfolio transfers. And business combinations are, again, there's another IFRS standard for business combinations. That's IFRS 3. So Chapter 11 similarly looks at how business combinations and portfolio transfers, the requirements of IFRS 3 are applied in the context of insurance contracts and IFRS 17. So Chapter 11 is quite an important one for anyone who's advising an entity that has recently acquired an insurance business or has been involved with a portfolio transfer or related transaction whereby there's a combination of portfolios of insurance contracts. So that's Chapter 11. Then Chapter 12 on transition. Now, arguably, this is probably the most important topic in the entire IAN, or at least it's the one that's probably on the top of the minds of many at the moment who are implementing IFRS 17. This chapter covers approaches for transition to the new standard. So again, IFRS has more generally set out some broad rules for transitioning onto new accounting standards, so generic rules. IFRS 17 then specifically provides some guidance and some requirements around how that's done specifically for insurance contracts. So in particular, the standard IFRS 17 sets out 3 methods for transition to the new standard. The default method, sometimes referred to as the full retrospective approach, effectively is to go back in time to the inception of all insurance contracts and then roll forward to the transition date without the use of hindsight to get to the opening balance, what it would have been under IFRS 17. Now, that can be challenging, particularly for many long-term insurance contracts where that information to get back many years in the past might no longer be available. So if it is impracticable to apply that full retrospective approach, then the standard allows 2 other approaches that can be used only if that full retrospective approach is impracticable. Those 2 approaches are the modified retrospective approach and the fair value approach, which I just touched on a moment ago. Yeah, this is one of the largest, this is the longest, one of the longest chapters in the IAN, and obviously very important for actuaries advising entities on transition to the new standard, and probably quite time critical as well, given that the standard will become effective on 1 January 2023. The transition date to the standard for a 31 December reporter will be 31 December 2021, so that's coming up soon. So for many insurers, yeah, this is a really important topic, and does have quite a significant, potentially a significant financial impact for the go forward financial statements. So very briefly, other topics, couple of miscellaneous topics in section D. Both of them still pretty important though. So firstly, chapter 13 on embedded derivatives builds on actually another IAN 10 released by the IAA on specifically embedded derivatives more generally. And this chapter just sets out some more IFRS 17 specific considerations. And the chapter 14 on modification and derecognition. Again, IFRS 17 has some quite specific requirements for contract modification and derecognition. And these are they're set out in the standard. But again, this chapter 14, covers those in a little bit more detail, and hopefully provides some sort of practical information on the application of those requirements for the standard. Finally, section E, chapters 15, 16, and 17 cover the presentation and disclosure requirements. So normally, presentation and disclosure really is the realm of accountants. In most entities that I've been involved with, the presentation, profit and loss statement, the balance sheet, and all of the related disclosures are prepared by the accountants. However, in many cases, there's still a lot of input from actuaries in those sets of financial statements. So we thought it was important to cover these topics, and so that actuaries can be aware of the requirements. So very briefly, chapter 15 is just an explanation of some of the key terms under IFRS 17 for presentation and disclosure. Some of those do differ from what many would be used to under current GAAP requirements in their local jurisdictions. So we thought it was important just to set out some of those presentation and disclosure terms, things like the insurance service result, insurance contractual revenue, etc., and how those come together in the profit and loss and balance sheet. Chapter 16 then covers presentation, so effectively P&L, balance sheet, and chapter 17 covers the key disclosure requirements under IFRS 17. So for chapters 16 and 17, what we've done is we've covered those key requirements for presentation and disclosure with reference to a number of publicly available illustrative financial statements documents that are produced by some of the large accounting firms. So hopefully that's helpful, and we do provide references in there, so you should be able to use that chapter and then refer to those other wider documents that are publicly available. So that is a quick run through of everything in the IAN, all 252 pages of it. I see we've got about 20 minutes left, so I might hand to you at this point, Dave. And then, if there's questions, we can cover them at the end.
Okay, yeah. Thanks very much for that, Brendan. That was pretty comprehensive. Well done. Before I start on the next steps, and it is important, I'll mention why in a second, it is important to talk about our next steps. I just wanted to reiterate what Derek said about the volunteer effort we've had on this. Derek mentioned some names, the people who were chapter leads in the production of the IAN 100, but there were also a number of other people involved, as he again mentioned, but I just wanted to reiterate that a lot of these people over the last 20 years or so have put in hundreds and sometimes thousands of hours. And I want to be a little bit biased. I know I'm an Australian actuary as well, although I've been hopping around the world for the last 10 years, currently based in the UK. There's one particular Australian actuary who hasn't been able to attend our meetings, but I know has put in many hundreds, probably thousands of hours over the years. His name is Bob Buchanan, so thank you very much, Bob. So next steps. The first reason we need to talk about next steps is, as Derek mentioned, the IAA has been restructured. And as part of that restructure, the subcommittee that we've been using to basically support all our work on accounting issues, and in particular, of course, the IFRS 17, that subcommittee's now been disbanded, and it's been disbanded for a good reason. What the restructuring is saying is that we need to focus more clearly on what we need to do, and to have a subcommittee that's just sort of sitting there waiting to do things, albeit that it's sort of there when you need it, it may not be quite as focused as what we need. So we're now talking about putting together task forces to do specific needs for the next steps on this standard in particular, and you know, broadly across the IAN in general. And I'll mention that for one good reason. What we've done in the subcommittee over the last 20 years, amongst other things, is we've produced 3 monographs, and what these monographs have done is provide sort of foundations to the educational support. We've got monographs firstly on stochastic processes, secondly on discount rates, and more recently on risk adjustment. Now they're all available on the IAA website, and they're all important because what they effectively do is say, of all this vast mountain of actuarial work on these 3 issues, which is the most important, which are the ones that tend to be used in practice, which are the ones that maybe back up the new accounting standard the best, and that's what those monographs are doing. So they're probably, if you can get through the many pages of this guidance note, it's probably at least worth referring to those monographs in certain places. As you'll recognise, they're basically supporting the general measurement model, so it's good foundation for that. So the 2 reasons I need to talk about next steps. Firstly, as I say, we're disbanding the old, or we've already disbanded the old subcommittee. Secondly, the force, the driver for the new task forces that we may or may not need will be provided by the members. So the accounting representatives at the various full member associations will be basically saying, these are the things we want you to do, through their representation on the Insurance Accounting Committee. So Derek will obviously monitor that and assess as necessary what needs to be done, but effectively the force for those next moves will need to come from the FMAs, the full member associations. And it is important that we do talk about next steps, in my view, because what this IAN has produced so far is the latest position. As we mentioned earlier, this standard is not going to be enforced until early 2023. So we really don't know what practice is going to do and how things are going to change as a result of the standard. We're making our best guesses, if you like. So this IAN 100 will continue advancing to take account of those practice changes as we go forward. The IFRS 17, as the IASB has made us well aware, is principle based. So we're expecting a range of areas and where we can be providing actuarial support, and those areas may not be the same for the same parts of the world, for the same parts of practice, for the same types of contract, but we will be establishing a range of new practice, I guess, as we go forward, as the various bodies find out what's going on. I'm sort of following on this slide. I'm following the new structure. Instead of using impact, I prefer the word influence, because I think that's more descriptive what we're trying to do at a global level. Impact is a nice word to use when you're sort of point scoring, if you like, but influence is, I think, really what we're trying to do at the global level. We're also trying to obtain the confidence, if you like, or assurance. We have to make sure these words begin with I, A, and A, of course. But so we're looking at words that that make sense in the way we're going forward. But we're really looking at the type and detail of support that we need to provide to the various member associations around the world. And then, of course, as we go forward, we'll find that we're accepting more examples in the way of practice as it develops in the area of IFRS 17 and the support of that area. So perhaps if you can move on to the next slide, please, Christian. So the important area is influence or impact, whatever you want to call it. It's the global level stuff, if you like. We need to continue liaising with the IASB. We've been working with them as a group for as I say, over 20 years. That will continue to take place. What I'm sure you'll all recognize is what the IASB has done is effectively taken an actuarial model. Okay, we're biased, we're going to call it an actuarial model. They don't call it anything to do with actuarial, but effectively what they've done is taken an actuarial model into the general measurement model and put forward that model as the basis for accounting for insurance contracts. So we need to monitor. I hesitate to say police. There's not much we can do in the way of policing, but certainly monitoring strongly the use of that model and at least make suggestions where that model seems to be going off the tracks. And that's a key part of, I think, what we're going to do going forward. And also, of course, we need to continue holding webinars and producing any other educational tools that may be needed to spread the word in the next couple of years or so, and then going forward with when the standard has actually been enforced. So next slide, please, Christian. We're also needing to look at the usage of IAN 100 by the various member associations. Now, as I say, I've been sort of hopping around the world for the last 10 years. I've been in different countries, talked to different actuaries in those countries. And there seems to be a range of approaches to what they will do with the educational support we're providing through IAN 100. There are some member associations, countries that really will rely totally on that. They won't be producing anything themselves. They'll just say, well, look, there is a guidance note produced by the IAA. That's what we're going to use to help us support the IFRS 17. And that, of course, will need a certain type of support by us to make sure that they're firstly using the note appropriately, but also that we're able to assist them in interpretation and advancement as things go forward. We're talking about a boundary between IAN 100 and education produced by the individual associations. That's because many of the individual associations are basically saying, well, we know what to do with IFRS 17. We don't really need a global international note. But we do need to basically say, well, there is the international note there, and make sure that there are no variations, major variations in the theme, if you like. As I say, it's a principle-based standard, so we're not expecting our note to be definitive anyway at all, but the same would apply to the individual associations guidance as well. And I think it's up to us to basically monitor that and try and make sure that the boundary isn't breached. And then, of course, we've got our educational role, again, through webinar and support. We can support the various associations around the world in what they think their needs are. Okay, one more slide, final slide, please, Christian. And then finally, we've talked about, Brendan talked about the way the guidance note stands at the moment. We've already talked in committee about a number of ways that we can augment that, and the main way, I think, is to develop the examples of the use of various actuarial practice for the various parts of the standard. Those examples will be built into the educational material as part of IAN 100, perhaps, but also maybe as a separate development. Again, we've not discussed that in detail, but it's probably one area we do need to focus on quite clearly. Second point here is keep moving with actuarial practice as it responds to IFRS 17 and as it takes into account IAN 100 and perhaps disagrees with it in areas. Perhaps parts of IAN 100 aren't really reflecting the reality of the situation, and we need to make sure that our development takes that into account. And then finally, keeping abreast with the effects of any changes to IFRS 100. We're not expecting any at the moment, but as we've seen, particularly in areas like reinsurance, there's potential for change. Certainly was over the last 2 or 3 years before the standard was actually produced. And we need to be aware of that and take account of that as we go forward. So I think I'll stop there. We're allowing 10 minutes now for questions, Derek. So I think it's probably enough from me, and I'll hand it back over to you.
Thank you very much, Brendan and Dave. We have come up through chat one question: is IFRS 17 compulsory in all countries or only in some countries? And the easy answer to that is no, it's not compulsory. Many countries in the world have their own endorsement process, and they have their own accounting standards board, and that accounting standards board decides what the accounting standards are in that particular country. And if you take Europe as a whole, there is a body called IFRAG, which looks at standards such as IFRS 17 and decides and recommends to the relevant bodies, is IFRS 17 appropriate for Europe? And they have decided that there should be a slight amendment to it in respect of annual cohorts for certain BFA business, which if you're a European country, you can adopt that. But if you are if you have a listing elsewhere in the world, you will have to apply the standard as it's adopted in that particular country. Brendan, I don't know if you want to say anything about who's adopting IFRS 17 in the Southern Hemisphere.
Yeah, so in Australia, New Zealand, it is being adopted throughout both of those countries by all insurance entities. And that's, I mean, an interesting one. There are actually, my understanding, not many countries in the world where it applies to all insurance entities. Some countries, I think, restrict it to listed entities and the like. In other parts of Asia Pac, many countries are adopting IFRS 17, but there's quite a variation on when they will adopt it. So you can take your pick of countries around the APAC region, and you'll probably get a different effective date for many of them. But yeah, probably most countries in the Asia Pac region will adopt IFRS 17 in some shape or form.
But basically, there is no compulsion. There's nobody in the world that can compel every country to adopt any particular accounting standard. It was always hoped that most of the world would adopt it, which is why the standard was developed in the first place. And I think many will. But by not every country. Gabor asked if we could provide a high-level overview of some of the specific parts of the EM where we believe it provides particularly useful background information or practical examples. I hope that note was sent fairly early on in Brendan's presentation. I hope as Brendan went through it, I certainly felt there was some good examples coming out of how the IAN did tie in with the standard and gave up examples. If Gabor, you or anyone feels that more might be needed on the next presentation, perhaps you could send me a note directly, but we certainly couldn't change the presentation mid-flow. But thank you for your comment. Are there any other questions from anybody? If you have one, perhaps either put it in the chat room or raise your hand. So if I can ask a couple of questions, Brendan or Dave, from your experience, do you think companies that are looking to adopt IFRS 17 are on target of where they need to be to get the standard adopted by January 23?
Can I take that first, Brendan? Yeah.
Yep, go for it, Dave.
Just generally around the world, it's it's a bit like the curate's egg. So that's a very British thing, Derek. Sorry, but it's there are good parts and bad parts. Let's put it that way. There's some parts of the world that really are sort of expecting to adopt it immediately without any preparation, and I find that hard to believe, but it's still the case, I'm afraid, and these may be countries who eventually decide not to adopt it at on the 1st of January 2023. But having said that, there are definitely countries who are very well prepared. Whether that applies to all companies in that country, I'm not sure, but I know of a couple of places. Certainly the UK seems to be preparing pretty well. I think I'll leave Brendan to talk about Australia, because I've seen mixed answers there, depending on life in general, to be honest. But yeah, certainly the UK, I've seen good preparation, and Canada, of course, is probably the example where things seem to be moving forward really quite well. Brendan?
Yeah, agree with that, Derek. I think, from my understanding, the Canadian regulator has been quite focused on it, and that's put Canada in quite a good position. Though you might get a bit more on the next webinar from some actual Canadians on that one. As far as this part of the world, Australia is one of the countries that is, so every insurer in Australia will adopt the standard, which is that's a little bit unique around the world, and probably the summary from this part of the world, in my observation, would be the larger life insurers are reasonably well progressed, followed by some of the larger general insurers, non-life insurers. But then there's many very small insurers that are probably not that well progressed at all. So it very much depends on the entity, I think, the size of the entity and the type, the complexity of their business. Whether it's generally life insurance, it's a more complex implementation program. And then probably for sort of around Asia Pac, probably a similar approach, although that does differ by country. And as I said before, many of those countries have pushed out, many countries around Asia Pac have pushed out the effective date. So their local regulators have said, we will adopt the standard, but not till, for example, 2025 or 2026, and therefore they've got a bit more time.
Yeah, just addressing the question we've got on reinsurance accounting for inward treaties. This is from Cho Leong Yong. Do cedents need to submit an IFRS 17 version of the statement of accounts to reinsurers? I mean, as Brendan was mentioning earlier, what IFRS 17 is doing is basically saying to reinsurers, you need to assess your accounts completely differently from direct business. So reinsured business has to be declared as an IFRS 17 return. So what insurers need to do to reach that point is up to them, basically. If they feel they need information in a different way from their cedents, then they must say that. Now, I would guess that in most cases the answer is yes to that question, but again, we'll have to wait and see. I mean, I wouldn't be surprised if reinsurers aren't immediately aware of that requirement, the full requirement anyway, and therefore they'll spend a year or two sort of getting used to collecting the right information, unless they're very well prepared. If they're very well prepared, then I think the answer is they will go to their cedents and say, we need this information in this way, in order to prepare our IFRS 17 accounts. If that happens, then of course that's fine. But as I say, I suspect from what I've seen so far that that may not be happening fully anyway. Hopefully that answers your question.
Thanks, Dave. There's a question from Thomas Fallows. A number of entities I'm aware of are expecting another postponement or delay in the implementation of IFRS 17. As far as I can tell, there's no basis for this except possibly on a local endorsement level in certain countries. Could you please confirm if this is also your understanding, i.e. there will be no further postponements? That's certainly my understanding. And I think now that the EU has given quite a clear indication that they are going to endorse, I think it's unlikely that there will be any delay, but never say never. Dave or Brendan, anything you want to add?
No, I think that's spot on, Derek. Yeah.
Okay.
Just Derek, you might just be mentioning. Gabor's just reminded me about this bow wave effect.
Yeah.
It's we weren't intending to cover that today. The bow wave effect, just for everybody's benefit, is something that appears to be coming out of the use of the VFA, the variable fee approach, on the types of contracts that allow that. What it's basically saying is that like a bow wave in front of a ship, it's sort of pushing forward profits to the end of the contract if it's interpreted in the way that people are interpreting it. And people may be interested in that. And I think Derek, the intention was to make some comments on that in our next presentation. For those who can attend it, of course, it might not be a very good time for a lot of you, but the presentation on Wednesday, we're trying to get Max, or we're going to get Max Hapacker, who's a vice chair of the committee, to make a comment on the bow wave effect, because he's done quite a bit of work in that area. But that's really, it's a very detailed area. It's really just one of the areas where we think, you know, internationally, that we can make a contribution going forward.
And I think the intention is to perhaps put some note out. I don't know how, but we perhaps to post something on the web which just discusses this concept of bow wave and how it might operate, or ways to address it. Sorry. Well, I think we've got through to the end of the hour, so thank you very much, everybody, for your attendance and for your questions, and enjoy the rest of your day, whichever part of the day you are in. So thanks very much, everybody.